FTSE Russell is an index provider and research house under the LSEG umbrella. They specialize in convening the best ideas on evolving market trends and helping to develop strategies for global investors. In this series, we look at the evolution of the biggest of today's trends. Over recent years, passive investing and the rise of indices have become increasingly influential in allocating capital towards climate change initiatives. I spoke with FTSE Russell CEO Arne Staal about the role that indices now play in affecting that change. Arne, thank you so much for taking the time to chat with us this afternoon.
Of course, and thanks for spending the time with me.
The main issue I want to chat with you about is really around how the world of finance can affect the world of the environment and climate change. And with the rise of passive investing, are indices now playing the most important role when it comes to affecting ESG and issues in and around climate change?
There is so much that needs to happen through finance to support sustainability and climate goals in particular. So financial markets have a huge role to play there, because this is all about reallocating capital to supporting a transition to a much lower carbon economy globally, not just for individual countries. And that requires capital flows to go to different projects, to different companies. By funding new types of projects, climate technology, for example. So some of the solutions that we don't even know about yet, they need to get funded. But also to help existing companies transition. So to lower their footprint, to modernize their processes, to re-engineer their business models entirely. And finance has a huge role to play there, both on the capital market side, so raising capital for new projects and raising capital for companies, but also from a secondary market, from an investment perspective. So both from an active and passive stock market perspective, bond market perspective, there are huge opportunities to help capital flows drive the sustainability objectives, really. And passive investing in particular, it's often thought that you need active engagement with companies from a shareholder perspective to drive change. We actually believe that indices, both because they underlie very large capital flows, especially in equity markets, but increasingly in fixed income markets as well. FTSE Russell has, by our latest estimates, probably around $18 trillion or so benchmarked against it. So huge capital tracking these indices. And so indices have a key role to play because of that, just because capital flows are so tied to them, but also because they have a function to play as a clearinghouse for engagement. So if you imagine there's lots of individual active investors that all want to engage with a corporate, but they might be saying slightly different things to the corporate. And the net result might be that you don't actually get the outcome that the overall economy needs. So through an index, there's a mechanism for collecting all those views and representing them at scale, at that $18 trillion, at that huge economic scale. So yes, absolutely.
So as demand has picked up for the use of indices, how have FTSE Russell tried to adjust their product offering to try and accommodate, this new demand, but also a new demand for ESG?
So ESG used to be about scoring individual companies. Tesla, are you high ESG or are you low ESG? And the question then is, what question are you answering really? Is it a good green company? Is it a good social company? What is?
Well, let me just ask you there then. I mean, do we need to have a better way of measuring ESG before we can start to score these companies on an ESG? I mean, you mentioned Tesla, but like Facebook and Amazon, I'm not an expert. It's like, I wouldn't know, are they good ESG or are they bad? Because it's not just about carbon footprint, it's about diversity and the way they treat their employees and things.
The answer to that is transparency.
Right.
The answer to that is standardization of data and methodologies. So people start speaking a common language. They have a common, I think of it as a base of truth.
Right.
Because currently people are saying similar things, but they might mean entirely different things because they're working with different data sets, different definitions, different methodologies. So yes, there'll need to be much more standardization. And our approach is very much what I call open architecture, which is to make the methodologies transparent, make the data transparent, but also allow people to bring in new components, new intellectual property. And that is important in ESG and sustainable investing, because for this to matter, it has to matter at scale. And for it to matter at scale, people need to be able to work across the landscape and not just with one provider like FTSE Russell, for example.
I mean, it sounds like the retail investor are trying to do their bit, and the finance world, particularly FTSE Russell, are doing their bit by allowing people a product which can allow them to be more specific about the companies they invest in. But how about at the top level, the political level? And I know you've just been involved with COP26, so I wonder if you could give some thoughts about what really needs to happen there.
We're all somewhat skeptical in our own different ways, and sometimes I think, well, it will last my time. But as soon as you have children, that perspective changes completely, right?
I can concur. I have one myself.
I worry. Yes, yes, you do. I worry about climate change. And I worry that there is a lot of movement in the right direction. There's a lot of commitment and a lot of understanding growing. But if you look at the timescales that we're working on and what the science says, so the consensus science, what I take as my guidelines, because I don't have my own unique insights on top of that, then time's running out. So COP26 is hugely important because it brings together so many different interests at a government level, at a corporate level, at NGO level, standard setting levels, all these interests coming together, and that's needed. But what's also needed is urgency. And you see the urgency from the individual contributions and the speeches and the commitments, etc. But the overall picture is not yet lining up with a path to low carbon economy that lines up with what the science thinks needs to happen. So the 1.5 degree scenario that people often speak about from the Paris agreements, that is not achievable yet with the current commitments and the current net zero targets and the what are called the national development committees. Those are not lined up yet.
So I know that Europe is probably a little bit ahead of the US in terms of having a price for carbon, but do you foresee that America will be quick to follow in terms of pricing carbon and finding a way of accelerating the corporate change?
So the pricing carbon question is a hugely interesting one because yes, there are mechanisms in place in different parts of the world to look at carbon prices, but there is not a global market for pricing carbon yet. And to really start pricing carbon, we need a market for carbon like we have for global equities, like we have for other liquid instruments. And we're still quite a long way off that, and I think that would be an enormously important development, but we're not there yet.
So as we look out over the next 3 or 4 years, particularly in the world of active and passive investing, and perhaps the rising of interest rates being another trend that we're possibly going to see, how do you see the world of investing sort of play out on that playing field?
The big trends that I see are ESG and sustainable investing driving change in investment styles, and that is both important to the passive investment world and the active investment world. I think short term that means lots of people trying to adapt processes and get new data, but also re-engineer how systems work, for example. If you want to give a good picture of the carbon footprint of a multi-asset global portfolio, that requires a lot of data, but also a lot of systems functionality. So that's a near-term requirement that is driving a lot of changes. On top of that, you have the other big global trends, technology and data, what I call data democratization, really driving a lot of consolidation of capabilities. So even 10 years ago, you could not do what you can today in terms of technology and trading and seamlessness and the low cost of doing a lot of things. So that is changing how investing works. The bar in some ways has become lower for being able to provide access to markets. That's a big change. And then you have the big demographic trends and interest rate trends and questions about inflation. And certainly if rates start rising at a persistent pace again, that will completely change investing as you know it, as I've known it. There are not a lot of people around that have seen other environments than what we're used to.
For sure.
In terms of low rates.
And am I right in thinking that at FTSE Russell, you also publish research yourself to try and highlight these issues? Can you perhaps talk about that?
Yeah, we're very active, especially in climate again, because ESG, sustainable, is a very broad topic and lots of very important dimensions to that. But we touched upon climate and the urgency of that. I see that as one of the main focus areas there. And we published a lot of research on that. We've recently published what we call the Net Zero World Atlas. And it basically gives at a country level what the implied temperature rise is that is implied by the policies and the commitments that individual countries have in place. So the net zero target, the nationally determined contributions, the current law that they have in place, how that impacts what we think the impact of a country on climate will be. And that's the type of awareness and the type of transparency that I think investors need, financial markets need, but more broadly we need as well, because there's so much confusion around this topic that we need clarity and we need insights.
Right. So it sounds like the more, conferences there are, the more research reports that get pushed out there that just raise awareness, hopefully that's going to start to trigger and continue the momentum.
Yes, I think, yes, very much so. There's one thing that I worry about that might be a break on the speed at which we move, and that is the risk of greenwashing.
Right.
So the risk of
So what do you mean by greenwashing?
As sustainable investing, ESG, climate has become so important, there are lots of commercial opportunities that come with that.
I see.
So being the first to market with a new climate solution, a new climate fund, a new climate index, a new climate analytics platform, whatever it might be.
Right.
There's commercial value in that. And what we need to guard against is that we have things that are being sold under a green label or a sustainable label or an ESG label that don't quite line up with the impact that people think it might have. Right. And that is a risk that I see. And if I can just take a little bit more on that, a little bit more time on that. We know that historically ESG investing has been very profitable in equity markets. So ESG investments have done well. And that makes it easy for people to invest in ESG because their financial incentives line up with their principles and their objectives. But at some point, and maybe when rates start rising, maybe ESG investments do not have that outperformance effect anymore. Yeah. And then there will be a trade-off between, well, what is my principle, what is my financial incentive, what is my climate target and belief, and what is my financial incentive. So we need to be very clear that those are two different things, and it's great if they match, but we should also be ready that we need to stick by our principles even when it's necessarily a financial consideration.
Right. It's interesting because I think there are still some very large funds out there that don't have an ESG mandate, and the more that happens, the more you may get this virtuous circle of companies feeling that they need to be much more ESG aware, and that will lead to the better performance. So hopefully we can get in that groove and it will be self-fulfilling, so to speak.
Yeah, and this is a bit technical, but forgive me. So we get a lot of people asking us, we run some of the largest benchmark families in the world, so markets that capture the overall investment opportunity in the UK, in the US, in China, different countries, different sectors, etc. And the benchmark families tend to be market cap weighted, so they just represent the overall investment opportunity out there in a liquid and transparent way. Increasingly, we're getting the question, why are not all your benchmark indices ESG indices?
Interesting.
But then there wouldn't be market cap weighted indices anymore, because currently the companies that are the greenest are not the biggest, to put it in very simple terms. So will come full circle when the market cap weighted indices are the ESG indices.
That's interesting. Well, listen, Arne, thank you so much for chatting with me this afternoon. It's been really interesting.
No, thank you. It's been a pleasure.
Thank you so much.
Thank you.
Sustainable investing and the role of ESG in corporate culture was something that was certainly talked about for 10 years, but it didn't really translate into investment opportunities. But now, due to the rise of indices allowing more direct investment into ESG and sustainable themes, capital allocations are accelerating these trends, creating opportunities that are only going to get bigger and more diverse in the future. If you'd like to read more on this topic, please go to FTSERussell.com/research, where you'll find much more information.